Welcome to The Explainer. Today, we're jumping right into the world of small cap funds, where two of the absolute biggest players are using wildly different playbooks to get to the exact same place, the top of the charts.
So here's the big question, right? How is it even possible that two top-tier funds, Bondon and Quant, can both dominate the field while following philosophies that are, well, they're practically polar opposites? Let's start with the strategist.
All right, first up, let's meet our strategist, the Bundan Small Cap Fund. Now, you got to think of this fund as a super cautious but really ambitious explorer, meticulously mapping out its every move.
34%. Just let that sink in for a second. A 34% annualized return over 3 years, that is just incredible. It puts them right at the top of the heap. But, the really fascinating part isn't just that number, it's how they get there.
So, Bandon's entire game plan, it really comes down to three key things. First, they hunt for those hidden gems. Second, they diversify like crazy. And third, they always hold a nice cash cushion for safety and opportunity.
Most funds, they tend to stick to the same old playbook, right? The Nifty 500. But Bondon? Nope. They do things differently. They intentionally go exploring beyond that. And get this, over half of their massive portfolio, we're talking 180 plus stocks, comes from that lesser-known universe. The whole idea? Find those high-growth winners before anyone else does.
And you can see their commitment to managing risk right here. I mean, look at this. The fund holds about 13% of its assets in cash. That's nearly double what most other funds in this category hold. It sends a really clear message, right? Stay nimble, protect your capital first. Don't just aggressively chase every last penny of return.
Okay, so that's the strategist. Now let's switch gears and talk about our second player, the rule breaker, Quant Mutual Fund. I mean, if Bondon is the cautious planner, Quant is the total rebel, basically throwing out every piece of conventional investing wisdom you've ever heard. And the fund's CIO, Sandeep Tandon, he does not pull any punches. He flat out calls the classic buy and hold strategy a lazy style of money management. His point is that it's just completely outdated for the fast-paced world we live in today. So, if they're not doing buy and hold, what are they doing? Well, Quant runs on this unique proprietary system they call the VLRT framework. Think of it like a data-driven engine that's constantly crunching numbers on valuation, liquidity, risk appetite, and timing. This lets the fund totally adapt its portfolio to whatever the market is throwing at it, like right now. And this is where they really, truly break the rules. Conventional wisdom tells us you can't time the market. Quant says, actually, timing is one of our best risk management tools. We're all taught to run away from volatility. Quant sees it as a friend, an opportunity. They're not tied to any single style or thesis. For them, being able to adapt is their biggest strength. Now, you might have looked at their numbers and seen their performance dip a bit recently. But here's the wild part. For Quant, that's not a bug. It's a feature. It's part of the strategy. Their data basically screamed at them to take a risk-off position, to get defensive before the market turned. It's a disciplined move to protect your money, even if it means they trail the pack for a little while.
So, okay, we've got two completely different ways of thinking that both lead to incredible success. Let's really put them side by side now and see just how deep those differences really run. I think the best way to get this is with an analogy. Banton, they're like a master chef, carefully sourcing these super rare, high-quality ingredients to create a perfectly balanced, delicious meal. Quant, they're like a Formula One team, constantly in the pit, tweaking the engine, changing the tires, all for peak performance based on the track conditions right now. And you could see it laid out right here. One is all about wide diversification and protection. The other is super concentrated and all about adapting on the fly.
And this, right here, this brings us to the most important question of all. Which one of these approaches actually fits you? Because this isn't about which fund is better in some objective sense. It's about figuring out which philosophy lines up with your own personal investor DNA.
So think about it. If you're the kind of person who sleeps better at night knowing your portfolio is built to weather the storms, if you value consistency and steady, cautious growth over everything else, well, then Bond's strategic, careful approach might be right up your alley.
But what if you've got a really high tolerance for risk? What if you truly believe that with the right data, you can time the market? If you're willing to stomach some serious short-term swings for a shot at those extraordinary returns, then you might be more of a quant-style investor.
At the end of the day, there's no single right answer here. It's not about picking a winner. Both of these funds have proven that their models work. The real key to your own success is finding the strategy that you can actually stick with, through the ups and the downs, without panicking and bailing.
So it really all boils down to this one simple but incredibly powerful question. When you invest, are you hiring a strategist or are you hiring a rule breaker? Your answer to that question will tell you way more about your investing journey than any performance chart ever could. Thanks for watching.